Welcome everybody to Tank Talks. I'm Cinthia Murphy, head of ETF research for the ETF think tank. And today I'm really excited to welcome Aniket Ullal, who is head of ETF data and analytics at CFRA. Hi, Aniket. Thanks for joining me today.
Hi, Cynthia. Thank you for inviting me. Great to be here.
Well, Aniket does incredible research, so I'm really excited to talk about some of the latest research you've put out on the ETF space. But before we dive into all the crazy things happening in this market this year, I thought, I'd love to hear actually a little bit about your background. How did you end up in this place right now doing ETF research, data and analytics work? What appeals to you about the ETF space for this kind of work? So tell us a little bit about yourself.
Sure. I've actually been in the space for a long time. I started in the industry in the indexing space. So I was at S&P Dow Jones for a long time, where I was the product manager for S&P's US index products. So my role was to look at S&P's US indices, including the S&P 500 and various other indices from a commercial perspective, and figure out how we could launch new products, innovate on the indices and commercialize them. And really, my role was to look at our index franchise from just the US equity indices and figure out how to either sell data around it or license those out. And we would license out our indices for derivative products, both listed and over the counter, and funds. And ETFs became a bigger and bigger part of what I was doing. So we would license out, as you know, our indices for ETFs. And initially it was just two people sitting in a corner of S&P doing that, and that just grew. So it became a bigger and bigger part of what I was doing. And as I saw the space growing, I decided to leave S&P and start my own small business. So I started up a small data firm called First Bridge Data, which focused on building ETF data sets. And we built a lot of interesting kind of ways to segment and classify the ETF universe. And we would license this out to asset managers, fintech companies, hedge funds. And eventually I got talking to CFRA Research, which is one of the largest independent investment research firms. And that discussion morphed from being a discussion about CFRA becoming a client to eventually acquiring my business. And so that's how that happened in 2019. And that's how I ended up joining CFRA. So I've kind of been in the space for a while, but wearing different hats, as from the indexing side to being independent to now working for a research firm.
Yeah, what's amazing is that when I first started in this business, there really wasn't a lot of ETF data available. And I think sometimes we forget, we get so used to how rich the data is today that this industry is really only 30 years old, and data is still a relatively new thing in an industry this young. So it's cool to hear from the people who've been there from the beginning, actually helping build data sets that we all come to rely on today for everyday work,
Absolutely. And the interesting thing is making sure the data keeps up with the industry, because we've seen, as you've seen, such changes and evolution in the industry. I remember when I was at S&P, I'm talking 15, 16 years ago, we were really, licensing out the headline indices, right? The 500, 400, 600, the sector indices, the well-known S&P index products. And at some point we went from the asset managers coming to us and saying, which indices do you have? The conversation shifted to which indices can you create? In other words, I want to create new indices for particular themes, for particular factors, for particular segments of the market. And that was a pretty significant change, because we went from thinking about just licensing out our existing IP to being innovative and creating new products and new indices that could underlie various ETFs. And I think that really sparked a whole revolution in the ETF space. And I was fortunate to be involved with some of the early thematic launches, including, for example, Claymore's water ETF, many years ago, and so on. And so really seeing how the industry evolved from being around very broad-based exposure to smart beta themes, eventually factors, and so on. And of course, now we've seen a shift into active and defined outcomes. So it's been an interesting transition, and the data always needs to keep up with that. So it's fun. It's fun being in the data space and research space, because one is constantly evolving along with the industry.
So I know at the end, we're going to talk a little bit about what comes ahead, but what I think it's cool about the ETFs is that if you look at the 30-year history, I think it's, in moments of really market stress, or when things really get difficult, is when we tend to see like really cool innovation in ETF development. So if you look back to 2008, it wasn't until the 2008 financial crisis and its aftermath that we saw fixed income ETFs really become a thing and really find their traction, and then all this product innovation that's still happening today. Like we're seeing, the single treasury ETFs come to market now, and, the bond blocks, high yield suite of funds, different ways to access fixed income. Then we saw, in the bull market, we saw the surge of thematic ETFs, which I think of thematic ETFs as, the sectors for the way we actually live our lives, where technology is now a part of everything, but we really don't think too much. We don't live in the gig sectors format anymore. I think themes really capture that well. So we've seen all of that. What do you think it's like some of the interesting, most recent type of evolution of the ETF wrapper, if you will, that stands out to you in the last year or so?
Well, I think you're right to point, as somebody's been in this industry for a while, like me, I think it's right to point to the 2008, the great financial crisis, as kind of the important tipping point in the industry, because it really, investors, both professional and retail, were really wanted to move away from being in opaque instruments that they didn't understand. They really got burned with that during that period. And I think that was absolutely a catalyst for driving the ETF industry. To me, in the last few years, there's been a lot of discussion around active, right? And how active ETFs have evolved and so on. I think the jury's still out on that. I think we don't know how that's going to work. We've seen some active managers, for example, ARK, go through this tremendous period of excitement, and obviously now they're going through some challenges. We've seen active semi-transparent ETFs come to market in various types of legal structures. So I think one important storyline or thing to keep track of is what happens in the active space. And the reason I say this is because now we're seeing a lot of big traditional mutual fund managers enter the industry, right? We've seen that with Capital Group, Neuberger, and so on. And so I think how active eventually works in an ETF wrapper is going to be an interesting story. The second thing that excites me, I think, is I'm really interested in the defined outcome space, because to me, it's an evolution from traditional beta to smart beta to now more structured type products, where we have more, which has been more prevalent in European markets, for example, rather than the US, where you have much more prevalence of retail structured products than we do in the US. So I think that's going to be an another interesting thing to keep an eye on. And finally, I think a lot more true diversification in the types of products. So it was really just equities and bonds and maybe some commodities. Now we're seeing managed futures. We're seeing the whole bunch of asset classes that weren't accessible to retail investors earlier. So there's just so many things that are going to keep evolving and keep us all busy.
So I actually want to pick your brain a little bit on the active space, just because we at the ETF think tank, we track launches, closures, kind of like the state of the ETF industry on a weekly basis in what we call our ETF KPIs. And one of the things that we've been tracking is just this growth of active. So active ETFs, I've been in this business now, I think 13 years, counting, and every year is the year active ETFs are going to make it, and it never actually happens. And now we actually seem to be there. We've seen their market share go from like 2% forever to now it's pushing 6. And they represent today, I think about last time we looked like 12% of the revenues that come into this industry. So from your perspective, when you say that active is really going to be the next spot that's really going to be tested, is it just the classic problem of performance? Are they actually delivering value for that higher fee? Or is there something else here? Is it just benchmarking? Are we benchmarking them to the right things? Or what's the biggest hurdle, you think, for the active space?
Well, I think the most interesting question is going to be how do active managers enter the space? Do they launch greenfield funds or do they convert existing funds? And that's not an easy question to answer because if they convert existing funds, the advantage is you're bringing in a ready set of assets into the space. The problem is those assets are probably at much higher fees than the average fees in the ETF industry. If you launch greenfield funds, then you're kind of just like a startup and you're competing with every other small company to compete with the Vanguards and the BlackRocks who've got this huge lead. And so I think it's going to be a difficult choice. I mean, it all comes down to the fact that ETFs have put a lot of fee pressure and have introduced fee compression into the asset management industry. So whichever way it shakes out, I think it's going to be challenging times for active managers because the fees that were there in traditional mutual funds are not going to be there in ETFs. And so they're going to have to make this choice of do I launch new funds with lower fees and not compromise my current book, or do I convert assets? And so I don't know how that's going to shake out. That's a strategic issue of how they enter the market. There's a secondary issue of do active managers beat their benchmarks? And I don't think changing a wrapper changes that question. I mean, the reality is that it's hard for anybody to beat a benchmark. We don't study that in depth, but of course, S&P has been putting out their SPIVA reports for many years, and we know that historically active managers do find it hard to beat the benchmark. Having said that, I think there is a huge appetite in the industry for active management. I don't think we're going to see a case where everything is going to be all passive, and even passive itself has evolved right from traditional indexes to smart beta. So I think there's a space for everyone. I think we're going to see traditional Vanguard type funds which have the more traditional indexes. We're going to see the smart beta and thematic providers, and eventually I think we are going to see some active managers in an ETF wrapper be successful. I think there's going to be space for all players, but like I said, the strategic choices of how they enter, how they protect their margins, how they get market share, I think those things are still to be determined.
Yeah, it's tough. I mean, I think we spend so much time in this business, we forget actually how relatively small an industry it is. I think we looked at this last week, and revenues coming from expense ratios in ETFs, this is like a $10 billion industry today. I mean, if you're in the pet industry, you'd be in a $50 billion industry. So ETFs really are a small space that has very low revenue. So it definitely is a tough space, and one that's gotten tougher this year. So let's talk a little bit about your recent research, which we know it's been really tough markets. We know ETFs had a really hard time, like anything else. Every asset class is down, from gold to bonds to equities. I think you had great charts in your research that showed, developed ex-US, emerging markets. I mean, you name it, it's down. But I think the number that really stuck with me was, you had a stat there that said at the end of the third quarter, year to date, only 6% of ETFs are net positive in terms of returns for 2022. That is like 94% of them are down. Like, do you remember a time when this has happened before? I mean, what stands out to you in terms of the performance this year?
I haven't gone back and done the same analysis for 2008. My guess is it's probably going to be something similar. Of course, we didn't have the same variety and range of ETFs then as we do today. I have to confess, the number you highlighted did surprise me. I was curious to see how, I knew it had been a bad year for equities and bonds, but to actually go in and dig in and see the data and take the entire universe and see which ones actually had positive returns, I was surprised to see it that low. Now, if we include leverage and inverse ETFs, that number goes up marginally to about 8%. I exclude them because sometimes they tend to distort, what's going on in the underlying asset classes. But you're right. I mean, it is a very small number. We're talking 160 to 200 ETFs having positive returns. What surprised me is we sometimes view certain asset classes as being a hedge in times of, say, inflation, for example, or when rates are rising. Gold is a classic example. Real estate is something, real assets is something investors tend to gravitate towards during periods of inflation. And real estate is down significantly. REITs are down a lot this year, right? And I think part of it is because we've got this trifecta of factors, which is inflation, rising rates, and the conflict in Ukraine, all together making it a very challenging environment. I think the other thing to keep in mind is it's a reminder that we're in the era of central bankers, right? Ultimately, it's not just about individual asset classes. A lot of what's happening is being driven by how much liquidity is there in the overall market. And, ever since 2008, we've been in the era of central bankers. Irrespective of what happens, bankers step in, the central bank steps in and acts as a backstop to prevent a complete crisis, right? And so to some extent, their actions have determined a lot of what happens. And I think that's increased correlation amongst asset classes. So when liquidity comes in, all asset classes go up, including the speculative ones. And when liquidity goes out, like we're seeing now, rates go up, then suddenly everything falls. And I think to some extent, the fact that monetary policy has been so dominant in financial markets is probably explaining why correlations are so high between various asset classes. So now, will that change? I don't know. If you look at the UK announced a rather interesting fiscal policy, and then the Bank of England stepped in with their kind of policy. So again, you're seeing central bankers kind of stepping in and to some extent supporting or bailing out governments. And so it'll be interesting. But I think part of the reason we saw such a dramatic or kind of correlated um, downturn is because of the importance of monetary policy and the role of central banks.
Well, and through it all, and when the going gets tough, the other thing we always notice is that people keep turning to ETFs because you can be super tactical, you can be super short term, you can, get in and get out. So when you look at flows this year, I think we're about maybe $400 billion in net inflows so far this year, which is not a headline making number, but it's actually really strong for a market that has pretty much just been incinerating cash this year. So all the headlines that I usually see related to flows, and when you look at it, it's always about just Vanguard becoming an even bigger and bigger and bigger institution. What stands out to you in terms of how people are allocating and using ETFs to navigate a market that has pretty much humbled us all?
Well, I think with flows are interesting to analyze because there's two factors. There's a secular factor, which is ETFs as a product category is growing. And then there's within the ETF universe allocations across asset classes. If you look at the former, there's no question that the reason we have $400 billion in inflows despite this market is because ETFs as a product category are still popular, right? And maybe not as popular as last year. Last year we had like 900 billion in flows, right? Almost $1 trillion. And that's a staggering number. Like we had a huge increase in assets, ETF assets, driven both by inflows and the market performance. And then I think the year before that, we had about 500 billion. So I think we won't be as good as last year, certainly, or the year before. But the fact that we still have 400 billion, I think, is a testament to the resilience of this product structure. And like you said, the popularity of ETFs as both long-term and tactical instruments. But within the ETF universe, we're certainly seeing rotations into things we would expect. We've seen rotations, for example, into more dividend-oriented strategies. I think low volatility is certainly becoming popular again. And I think a category that, to my surprise, hasn't got as much attention as it should is currency hedge ETFs. With the dollars being historically strong, I was kind of surprised to see it hasn't got as many flows as it should. That could change. And certainly within fixed income, there's been some rotation from certain duration into other duration products. So it is possible to, those trends are in line with what we'd expect. The only one that kind of surprised me was currency hedging, because with the way the dollar's appreciated, one would have thought investors could have protected their downside more with currency hedge ETFs. But it's always easy to say these things in hindsight. So.
Yeah, but it is surprising. I agree, because I was thinking about, I'm sure you remember the year of DXJ. Everybody, that's all we talked about was that Wisdom Tree Fund. I think it was 2012. And it was all of a sudden, we all discovered currency hedging. We don't know how we ever lived without it. And then it just fizzled out. And I don't know why why it hasn't come back into vogue, just from the perspective that now is the time for that kind of strategy. Like, do you think it's something happened historically back then, and they stopped working and people got out too late, or they missed the dollar move? Or is it just, it shows that, we talk about all the innovation all the time, but we tend to kind of navigate to the things that we've already used or are used to? I mean, I don't know. I think it's surprising too that currency hedging hasn't picked up pace here.
Yeah, I agree with you. It is surprising, and I don't have a good answer for why that's happened. I think there may be tactical explanations. I think, when Wisdom Tree had that fund back in, I think maybe 2014, they has marketed it very well. It was very clear what was happening with the yen. I think they had fewer products to market also. And I think they really, really honed in on that message. It was novel. It was a novel idea. So I do think there may be tactical things related to the fact that they just had a fewer products and they really, really marketed that one thing well. It's much noisier market now. We've got, firstly, at the macro level, so many things going on with rates and inflation and the war in Ukraine. So it's much harder to get through these kind of nuanced messages in this kind of crowded market. And then, of course, you've got many more players who are all trying to promote their products. So it's possible that it may just be a marketing thing, that it's kind of got lost in the shuffle a little bit, because I can't think of any investment related reason why investors wouldn't have looked at it. I can think of more marketing related reasons why they didn't pick up.
Yeah, no, that makes sense. I mean, there's 3,000 ETFs and counting right now. So it's a lot to get through for anybody who's out there, either doing it themselves or advisors trying to figure out what ETFs to own. So Aniket, before I let you go, let's look a little bit to the future. When you think about, from either the product innovation perspective, all the launches we've seen, all the kind of different kind of implementation of the ETF wrapper we've seen. For example, one that I just read, it just came off registration, but there was this possibility of turning the ETF wrapper into that, pseudo ADR like type of exposure. So there's a little bit of a pushing of the boundaries of what the ETF wrapper can do. What do you think is kind of interesting to watch as we look ahead, either from a product development perspective or even from an implementation perspective, as the markets continue to challenge us?
I think there's a lot of products getting attention, right? Single stock ETFs are getting attention. We're seeing some of these products like, the Kramer ETF, for example, right? It's like some of these more gimmicky ETFs sometimes tend to get attention. But to me, the two things to keep an eye on is, one is, will ETFs become more like structured products? In other words, that's why I mentioned the defined outcome. Again, I think it's the fact that innovators up to about 3.5 billion in assets, to me, is interesting. It doesn't seem like a lot, but to introduce a whole new product category that's got adoption that fast, I think is interesting. So I do think the question is, now that we've seen the evolution from traditional beta to smart beta, will we see an evolution to more structured outcome or defined outcome type products? To me, that's an interesting idea. I think the second thing to keep an eye on is ESG, because it's been a space that got a lot of attention, and then, like active in the ETF space, kind of has been treading water. It hasn't really gone anywhere. It's been stuck at that 2 to 3% mark. But if in 5 years or 10 years, investors decide they want to have ESG in all of their core holdings, that's going to be a very fundamental shift. Instead of holding the S&P 500, I may hold the S&P 500 ESG ETF, for example. And that hasn't happened yet. If that does happen, I think it could be quite transformative in the industry. And the question is, will ESG get embedded in the investment process of core portfolio holdings? I'm not sure I have the answer, because there are trade-offs there in terms of performance and so on. But if that does happen, I think that will be also an interesting thing to keep an eye on. So, and in addition to that, we're going to have all of these interesting new product launches like single stocks, and like you said, new types of ways in which the wrapper can be utilized. So I think it's exciting days ahead. Lots of things to keep an eye on.
Yeah, no, for sure. Aniket, I want to thank you again for joining me today and talking about this industry we love. I want to encourage everyone to check out Aniket's research through CFRA. You can subscribe to it, right? I think I'm a subscriber. That's how I
Yes.
got
Yeah.
it.
Yeah.
It's a great content, and we'll see you guys next time.
Great. Thank you for having me.